Hello, and welcome to Credit Matters, the podcast where credit absolutely matters. I'm Shankar Ramakrishnan, your host and head of US credit and global market engagement at Informa Global Markets. I'm here with my colleague and co-host, Bruce Clark.
Morning, buddy. How are you?
Good morning, sir. Morning. Head of rates market coverage at IGM. So today we are talking about cryptocurrencies, the advent of asset-backed cryptos and their correlation with and the impact on broader credit and riskier markets, how banking regulations have changed or about to change under the new US administration. We'll also talk about the impact of the Iran conflict on commodity prices. Are there lessons from the regional banking crisis we are still refusing to learn? To address these critical questions, we have Jill Cetina. Hi, Jill. Hi. Jill is the Associate Director of the Commercial Banking Program and an Executive Professor of Finance at the Mays Business School at Texas A&M. Prior to joining Texas A&M, Jill was the Associate Managing Director for U.S. banks and government-sponsored enterprises at Moody's Investor Service. At the Federal Reserve Bank of Dallas, Jill was a vice president of supervision with leadership of 6 teams with responsibility for banking supervision, macro financial analysis, and monitoring financial conditions and monetary policy formulation. Super expert, Jill. Super expert.
Thank you, Shankar.
Thank you for being here. Thank you very much. So I'm going to kick off the questions. I'm not a big follower of the cryptocurrency world, but I wanted to get your perspective on how, like what I've noticed about Bitcoin was earlier, it was like almost like a contrarian alternative to whatever was going around. But nowadays I see it's very aligned to the market. So if equities are down, it is down, Is it still connected to markets, or how is it? What is the correlation with the market, especially with Bitcoin? And has that changed?
Yeah, I think it's useful, Shankar, to kind of think about or sort of see Bitcoin and its evolution in I'll say, broader concern and deterioration around both the trajectory of U.S. government debt and rising government debt to GDP, and concerns about money, right? That's what got Satoshi. It was 2008, which got Bitcoin launched. And I do think that Bitcoin initially was kind of the standard bearer on concerns about the future of the dollar, concerns about government debt and debt monetization. And I think over time, while people may have accepted the critique of some of the Bitcoiners, people have also started, I think, to see some of the maybe flaws or concerns with the Bitcoin solution. The fact that while it's decentralized, there are a lot of we're a lot of very large so-called whales in Bitcoin, which had the potential to, even though it was decentralized, to significantly move price, right? We've also had, I think, the whole launch, if you will, of stablecoin. Right. And if you were interested in digital assets, that offers, as the name stablecoin would imply, a more stable alternative to Bitcoin. So I do think that has weighed on Bitcoin's, sort of prospects and caused Bitcoin to lose some of its luster. But I also do think that there's been a recognition that the critique of Bitcoin, that another alternative, and one that, as many listeners, I'm sure, know, that has been kind of pushed by folks like Ray Dalio, another alternative if one's concerned about the future of money and the value of fiat money is, of course, precious metals. And we've seen greater interest in precious metals. Certainly last year was a terrific year if you were trading precious metals. So I think there's some other, I'll say, alternatives that have taken some of the steam out of Bitcoin. Gold, again, super long role as an alternative form of quote unquote hard money. And then stablecoin if one wants to be kind of more digital native, but is looking for something that's kind of less price volatile.
Right, right. So, but you think the wild swings in prices in Bitcoin, that's kind of gone away, like moving from 60,000 to 150,000. I think people have predicted the price could go anywhere to even 200,000 or those things we are not going to see, or you think that that pressure or that volatility is gone?
I think that, there are other, again, why did the Bitcoin ship get launched in 2008 by Satoshi? It got launched out of a concern around, I'll call it the future of money and fiat money and debasement and that whole narrative. And I do think that, there's, it does feel like precious metals are a bit more of an alternative. Certainly, it's been evident to the market that central banks globally have been acquiring more precious metals, which creates I'll call it more stable bid, even if we've seen some volatile movements in precious metals more recently around what's gone on with the Strait of Hormuz closure and central banks needing to liquefy some of their gold holdings in order to have sufficient dollars. But I think broadly speaking, Bitcoin has faced some real headwinds here because there are alternatives. It may have diagnosed up front the I'll say situation around concerns about fiat money and the future of fiat money first. But I think some of that there are some alternatives that the market is considering, most notably precious metals. But then again, if one is interested in that digital space, I think stablecoin. If you, let's also be fair, Bitcoin, there were people who were interested in potentially using Bitcoin as a way of laundering money, right? And maybe now I can do some of those things, those same things in stablecoin, perhaps, and not worry about the price volatility. Well, that could be very attractive. So I think that's sort of how I think about the situation of Bitcoin.
Right.
To me, it's fascinating, Jill, to see where just a couple of months ago, the first thing that traders like me would look at when you turn the screen on, macro guys, would be Bitcoin. And Bitcoin was the dog and the markets were the tail being wagged. And, it was some kind of, indication of sentiment. And it's just sort of all faded away in the last couple of months. And I was asking some guys I work with yesterday, and I'm looking at the price of Bitcoin and the price of gold, that to me looked like it wouldn't take a whole lot to make these things look pretty ugly on the downside, to be honest. And and an honest question, like, what does that mean? Like, what are we going to see a resurgence of the dollar? Is it like is Bitcoin and gold, are they still anti-dollar trades? And I don't know. I don't know the answer. I mean, it's
the way I think about this, Bruce, is like there's a big I'll say shock to the the headwinds that the dollar was facing. Because like remember last year, right? You could have just gone long the euro and clipped a couple coupons and you would have achieved the same return as like the S&P 500, right? So that's how big the dollar's depreciation against the euro was. So we've seen, in last year, 2025, meaningful dollar weakness. I think we've stepped back from that in part because of what's happened in the Strait of Hormuz and because of the dollar's role in, all commodities are priced in dollars. And then when we have this enormous commodity price shock, right, we've got, energy prices, aluminum prices, some of the ag complex all moving up. So for the rest of the world, right, this is a big shock to, I'll call it the real money supply denominated in US dollars, what's just happened in the Strait. And this has kind of punctured, for this moment, the narrative of, dollar decline, dollar
Right.
depreciation, all of that. But all of those structural things, unfortunately, in my view, those structural forces that we saw in 2025 are still there. But we've got this geopolitical event that is kind of, I'll say, muddying those structural forces.
Right.
I mean, if you believe that we're deglobalizing and that there's going to be fewer trade flows, that is going to impact demand for dollars. That's going to impact
Right.
foreign demand for financial assets. And I think we are in the early innings of that, those structural forces playing out. But this has very much muddied the narrative. And if you were long all of these things like, precious metals, FX, like, other currencies, short the dollar, like
Right.
long the euro, long the Swiss franc, etc., you needed to unwind that as, kind of the Strait of Hormuz is unfolding.
Or it feels to me like it's about to get unwound for you.
Yeah.
And same thing with I don't know, as I turn the screens on this morning, you're looking at looking at oil prices at 6 weeks lows, and right, how many guys were pounding the table on $150 or $200 oil, right? And long bonds are going to 7% and this and that. It's like, things are, as you said, I mean, structurally, nothing has changed, but right now, the resolution to the conflict has certainly reshuffled the deck, and there could be some unpleasant squeezes in some popular themes here.
Right.
I would think.
Yeah, I do think that the situation in the Strait, how can I frame this? It could play out multiple ways. But I do think that the market, I think we're either on the fifth or sixth time of, basically, this is going to be resolved kind of thing. And, to be fair, there is more definition, if you will, around, this, some of the possible terms and whatnot. But like, let's be really clear, what is kind of being discussed in terms of resolution on Iran. What are some of the features of it? The Iranians get a lot of money, right? They get their assets unfrozen, and I do think that it's hard to look at what is being discussed kind of, at least in the public domain or the outlines of it, and not conclude that this is, leaves Iran in a stronger position.
Mm-hmm.
And so,
yeah, I mean, I wrote that in my piece this morning. I said, okay, so the market has embraced this ceasefire. Treasury Secretary Bessent was out yesterday, and he underscored the three red lines that the U.S. government has put forward. One being highly enriched uranium needs to be taken out of the country. No pursuit of nuclear power, and the reopening the Strait of Hormuz. Well, by my account, two of those issues aren't even discussed in this memorandum of understanding. So I'm like, why is the market so optimistic that this is all going to turn out well? I don't know. And again, I don't know the answer to that, but the price action is very, very sunny and smiley, again this morning. And I don't know. I don't see it, like, as you said, Jill, I don't see it in the text, but it is what it is.
I also think, Bruce, that when we think about the situation in the Strait, Vitol, one of the major commodity trading firms, one of their ships was blown up in the Strait.
Oh.
And 2 people died. Okay. So, I think that if indeed somehow we're able to get to a place where the Strait reopens, there'll be a lot of people that are interested in getting their ships out of the Strait. But are we going to see a lot of people interested in bringing their ships into the Strait, particularly when the current discussion is about a phased negotiation? Right? Where, okay, I could be bringing my oil tanker, which is as tall as, or as long as the, like a skyscraper. These are, huge, very costly ships. I could be bringing that into the Strait, and then there's a disagreement about the second phase related to the uranium. And then all of a sudden, like my people, my ship is at risk. I think that people are being a little, if I may, naive.
Yeah,
you may have seen.
It's not like the insurers are going to go, oh, well, okay, then, all good.
Yeah.
With a 60-day timeline, the insurers are not going to jump back in and offer.
Well, I think the insurers
favorable
and the trading firms and the people who are, the Maersks of this world are not necessarily like eager to jump back into that until things look more, meaningfully more stable.
Right.
And so I agree with you. There's I don't know if it's naive or fatigue, but the whole situation around the Strait, it just feels very kind of optimistically priced.
I've shaken my head every day this week. I've walked in. I'm like, what gold or oil's down 6-7 days in a row, and every day it's sort of the same news flow, and I just shake my head, going, what's happening here? I don't understand it. Because
Jill,
to me,
can I ask
I'm with
you,
Jill. I don't see this as being very optimistic, but
you may have seen the oil majors. This is just this week. We're talking about some of them that they think we only have a few weeks of left, in terms of inventory, because inventory has been the thing that has helped keep prices, below where they were realizing, for example, during Russia-Ukraine. And so these big inventory drawdowns, both in terms of the public sector internationally, as well as private sector inventories coming down. And I think, we, the question is always, and we had IAE, International Energy Agency Chief Barol over the Memorial Day weekend, talking about, sort of July, August timeframe. The oil majors this week, even more pessimistic, like that we only have a few weeks left in their view. Before inventories become a real problem and we watch prices, go parabolic. And I think that's, that's the thing that could happen here. Shankar and Bruce, is we could end up in a situation where, oil prices are around $90, and then we walk in one day and they're going parabolic, and everybody who, did risk on, is kind of going oops, but they've got all this company in their oops, right?
But is it should we use, everyone throws around the word bubble, right? Are we in a bubble now, do you think? Given your experience during these previous crises, it always seems to start like this, right? Everything is great, everyone is buying, everyone is pushing the market up, and then suddenly something cracks. But it seems like what you're saying is structurally it is going in one direction and the markets are going in the opposite direction, right? Almost, right? What do you think?
Yeah, I think we are in a very delicate situation with regards to commodities, right? All of these commodities that come out of the Gulf, and it's more than energy, as I'm sure many of the listeners, I know you both know this, but it's aluminum, it's helium, which is important for chips, it's sulfuric acid. There's all kinds of stuff that's important that's related to products coming out of the Strait beyond energy. And I think the issue is just that you get to a situation where, the inventories are gone.
Right.
And if we haven't really restored the supply chain, and the supply chain is a long supply chain, right? We haven't even talked about, risks when people try to restart production on the energy assets in the Gulf. But all of those things, if it doesn't, I'll say these are physical things. Central banks and governments can't print them.
Right.
You can't just, what they can do is they can print money, to allow, to subsidize their consumers. And if they do that, we will end up with even higher prices and even more inflation. We're starting to see currencies in Asia depreciate, right? Go look at the Indonesian rupiah, go look at the Indian rupee, the Korean won, right? There are cracks in the global economy that are starting to form. But, to the extent that we continue to have, I'll call it these verbal interventions and, headline interventions, news stories that come out on the day that say, peace is imminent and everybody's getting ready to hold hands and sing Kumbaya. We end up with financial conditions that are probably not reflective of some of the tail risks of if this goes to parabolic commodity prices.
Right.
And so, I think, one of my favorite sort of sayings from Keynes, is, let me see if I can dredge it up here, but basically, it's better to fail conventionally than to succeed unconventionally, right? So it's okay for me to follow the melt up in risk assets as a investment manager. It's okay for me to do that. And then if the tail takes me out, it took out everybody else, it took out the benchmark, I'm in good company, as opposed to maybe sitting back from that. And Keynes's point was, about unconventional success looks like being a bit contrarian. Well, again, when risk assets are melting up, that's a very difficult position to be in.
Right. So if you go unconventional, you need the war chest to go against a trend like this as well, right? Like it takes a while to unravel. Or do you have the holding power to keep going against the market?
Well, I mean, you basically have to not be mark-to-market sensitive, which, not being mark-to-market sensitive is a very, very difficult position to be in. Or you need to use option strategies, right? Not just be long, but basically be trading oil, like, doing puts and call strategies, whatnot, or trading calendar spreads or other things. But, very few people are, I'll say, fully insensitive to, for obvious reasons, right? Because, there's on the one hand, there's a discipline in mark to market. On the other hand, when there's a lot of, I'll say, headline and even verbal intervention induced volatility, it can mean that prices don't well reflect the full distribution of risks. Right. Or at least spot prices that we observe, options prices may do a better job actually at kind of revealing maybe more sophisticated players' thoughts.
Right.
So what you're saying, Jill, is that the market is not the economy, which sounds trite, but I've found myself writing that a couple of times this week, and again, I look at like who thought that first quarter GDP would be revised down yesterday, given the first quarter earnings season, right? That just came in monster earnings season, and the narrative throughout generally was the consumer's very resilient. And so you get the first revision of GDP, it's revised down to like 1.6%. Like, what the heck is going on here? And personal income totally flat. And but hey, Dell stock's up 40% this morning, so who cares, right?
So. Yeah. No, I mean, I just spoke earlier this week, Shankar and Bruce, like at a banking conference. And one of my comments was, what's so interesting here, right, is, and just to pick up for a minute, Bruce, on your point about, GDP in Q1. Basically, we had, the One Big Beautiful Bill Act refunds come through from 2025, came through in Q1 2026.
Right.
And so we had that as actual fiscal stimulus, if you want to think about it that way. Was, in the neighborhood, right? Like if you were to look at Bloomberg's model, their shock model for the US economy, it would say that oil prices moving up to $100, like basically that would be, shave about, 0.4 percentage points off of US GDP. Well, that is very similar in magnitude to the OBBA, right? And, so Q1, like the data for Q1 is probably, I'll say, kind of happy relative to what could happen in Q2, because we don't have a fiscal offset in Q2 to the shock in this, but this is continuing.
And I think the flattening of the yield curve here, especially this week, is telling us exactly that. But that's we can get into that later. But I think that the flattening of the curve, to me, is one of these red flags that says, that the economy is about to downshift here. That's what I think the message is.
Yeah, I mean, I do think it's super interesting, right, that many of the recession probability indicators for the US are, kind of floating around average levels or even a little bit below average, right? So what you and I are talking about now is definitely not in, I'll say, the narrative, that there's some meaningful US recession probability from the shock.
Right.
But I agree with you that, particularly if the longer, there's two ways I think we get to a US recession. And I think there's been, I'll say, a little bit of misinformation around, the US being a net exporter and therefore we're insulated from this. We are less sensitive than some of the Asian countries that I was alluding to earlier, who are net energy importers, right? We are certainly less sensitive than the Europeans and some others, right, who are net energy importers. But that is not to say that this doesn't have, create headwinds for the other parts of the U.S. economy, ex the energy sector. It is a headwind, and but we don't see that in the recession probability. I think this net exporter, to quote my own kids, like meme, it's become a little bit like a meme or a trope, right? Has so weighed on thinking that and I think the capex, the AI capex, the belief that that's just going to keep on powering the economy. And I think if we end up with energy prices and commodity prices staying high enough for long enough, which gets back to the duration of the Straits closure, or if we end up with the inventory draws getting us to a place where prices actually do go parabolic, either of those two things, I think then you start to talk about meaningful U.S. recession risk that's not priced in the market today. And that's why I was saying at this banking conference, I said to people, if you've got some credit stuff that you need to insure, sell, get out of the portfolio, do it now.
Now would be a good time. Yeah.
So Jill, can I also ask you this? Like, how sophisticated are investors? So if I have to hedge myself against this potential tail risk, I have to, what you were suggesting earlier is use, options and derivatives and complexity, basically complex instruments. How sophisticated is I'm sure there are some investors who are very sophisticated, but a broader swath of the markets is still, it's a very complex thing to add to your portfolio and then manage it or manage risk around it. Do you think that's going to lead us to other problems, like where someone has got caught on the wrong side of a derivative trade or a hedging strategy, which he or she didn't fully understand? What do you think that's possible? Because that has happened before, right? Where people have all gone into complex instruments and then realized they had no idea what they were doing. Is that what we are looking at?
Yeah, I mean, I think there's always those risks, Shankar. I do think, and I believe it was the IMF Global Financial Stability Report, had a nice piece. When I say nice, I mean it was good analysis, but it was a little bit concerning because it talked about the growth of option strategies in the U.S. And the leverage that's kind of associated with that. And that retail in the U.S. was playing a particularly large role in that. So, that, needless to say, in more volatile markets, in markets, I've used the word several times, parabolic, so far in this podcast, if you end up with very large price moves, that can become challenging in terms of settlement. You can get to, this is a show about credit.
Right.
So you can end up with those large market moves becoming credit risk for someone if they're not able to basically
Right.
meet the position. So
So-
yeah, I think that can become challenging.
Right. Because it almost seems like if we look for the red flags,
Mhm.
or where will the crack come if there is a situation? What would you say? Where would we see the first signs that things are changing or the market has overextended itself?
Well, I mean, I think we have had a big risk on rally against this backdrop of this very major, macroeconomic / geopolitical shock that has been unfolding since the end of February.
Right.
And I think, the risk is that we get to a place where the macroeconomy shows that is not well justified, and you get to a big repricing, and that becomes, I'll say, disorderly, unpleasant, whatever word you want to use. But
Right.
I think that the Asian currencies, the moves in Asian currencies, again, that is to me starting to show that there are cracks.
Right.
And just as with WTI being the last to move up, right? Because the U.S. Is a net exporter or an energy producer. I think that we're going to see, and there are cracks in other markets too. Some of the countries in the Middle East, they have, currencies that are pegged to the dollar.
Right.
There's been a lot of, I'll say, repricing there, where people didn't anticipate the level of geopolitical risk and had put money into real estate and other assets. So there's a lot of repricing of assets going on in the world. And I think that at some point, to think that doesn't affect risk assets in the U.S. strikes me as a little optimistic, but time will tell.
So can I take you back a little bit?
Sure.
You mentioned about stable coins, right? For someone like me who has no idea how these cryptocurrencies work, what are stable coins and what is this phenomenon? And how does that behave in an environment like this?
So my view of stablecoin is perhaps a little unconventional, but let me outline it.
Right.
My view of stablecoin is that this is intended to address a debt management problem that the United States has. And, basically, the Yellen Treasury, financed a larger share than was typical. And, just for listeners, at one point in my career, I worked in Treasury debt management. Okay.
Right.
I was actually the TIPS lady, the inflation adjusted
Oh, wow.
Treasury
Right.
lady for about not quite 4 years. But so I've been part of that team. And, the Yellen Treasury allowed the weighted average maturity of the Treasury market to fall, and used during COVID a meaningful amount of bill finance, which was criticized by the other political party we have in the United States, the Republicans. Right. And then they got control and basically have continued the same thing. And I do find it hilarious on both fiscal policy and debt management. No matter who ends up captaining the ship, the deficit as a share of GDP, continues to be outsized, and some of the I'll call it debt management practices don't really change. But to go back to my story about stablecoin, this increase in T-bill issuance and not increasing coupon and bond sizes in order to kind of finance the deficit across the curve, this means that there's quite a bit of bills that need to be issued. And I think the thought process, and this, you can see this in the Treasury Borrowing Advisory Committee discussions, some of the thought process in the Bessent Treasury was hey, we could do this sort of stablecoin thing, and that's going to create demand for bills.
Right.
And this also could potentially help stabilize demand internationally for dollars, right? Because the sanctions that were put on Russia during the Russia-Ukraine conflict, I think that there's a sense in which that I'll say reduced the bid internationally for dollars. There's a realization that the U.S. could freeze assets overseas. Now, you could ask, a reasonable person could ask the question, couldn't that just happen with stablecoin? And I think to some degree the answer is yes, but it gets back to our earlier point that it's maybe less volatile than Bitcoin, so attractive. So, you've got the Genius Act stablecoins, which are, I would say, more intended for the U.S. domestic market. And then you have maybe some non-Genius Act stablecoins that are being marketed overseas, to people who may live in countries where the currency is not particularly stable, relative to, say, the U.S.
Right.
What I don't like about any of this, right? And let me take a moment and be a little critical of this, short wham weighted average maturity strategy. If you were going to go off and attack Iran and cause a repricing of Fed expectations, that would not have been your optimal debt strategy.
Right.
Okay. So I think it's fair to say that something got out of kilter on the economic policy agenda and the foreign policy approach in the administration, right? Because if, I'm not going to say who I said this to, but I made a remark to somebody about 6-7 months ago that running a short wham strategy had embedded in it an assumption that inflation was kind of coming neatly down to target, and that you're going to be able to, Fed would be able to cut rates and all of these things.
Right.
So this stablecoin strategy was really about the needs of debt management, but this whole thing, Shankar, has like really, I'll say, not been executed. It's not played out, I think, as people initially expected. As somebody who is a banking professor, what I don't like about the Genius Act stablecoin stuff is it competes with bank deposits, right? And the reason that we've got this Clarity Act discussion about, can the issuers of stablecoin pay yield, right? Which then really sets them up to be competition with bank deposits. Banks are what fund small businesses in this country. That's what banking sector deposits do. Stablecoins fund government borrowing. And so this, in a very real sense, is the essence of government crowding out the private sector. It's what it is. And people can try to put the lipstick on the pig. I am very, very opposed to this, because in my view, it kind of sweeps under the rug the need for a real discussion about unsustainable fiscal policy in the US, and actually sets us on a path of squeezing deposits out of the banking sector in a way that can actually negatively impact small business lending.
Right. And sorry, Jill, one more thing I wanted to ask you is that, you were talking about when you mentioned commodity prices as well, you mentioned eggs, right? So what is going on there? Are egg prices on the rise? How is the whole situation in that? Because we keep talking about oil prices and all that, but that's like a real life commodity.
Yeah, on egg, I've focused a bit less on eggs, to be totally clear, but like more on like soybeans, wheat, some of the other commodities, corn, right? Why? Because all of these, I'll call it essential grains. A couple of things. Diesel is used by farmers at the risk of being kind of Captain Obvious about that. But so, to the extent diesel prices move up, that's a key input for them. Urea, which goes into fertilizer, you need lots of nat gas to make urea. So the Gulf states got involved in that.
Right.
Fertilizer, not necessarily affecting, this year's crops as much in the US, but Brazil does 2 cycles of crops, so could affect that. But also higher energy prices make people start to think about, should I use some of these crops also for ethanol? So that's on the demand side, right? You can use soybean oil to create ethanol. You can obviously use corn. So all of these things, from the Gulf have the potential for these impacts on, commodity prices, again, because of the diesel, because of the fertilizer. And I think those are risks that we're more likely to see late in the year, like in the fall and winter. But markets are thinking about them and kind of monitoring that. So.
Right. So that's the tail risk you talked about, from the
So Jill, do you think that when Scott Bessent was appointed Treasury Secretary, he came out and made it very clear that the singular benchmark for this administration's policy success was a 10-year Treasury yield?
Yeah.
And do you this goes to your debt management strategy, right? I mean, we're going to issue more bills, as collateral for stablecoins to take pressure off the long end and try to keep the long end from breaking away. Do you see any risk that the bond market could get away from Bessent? In other words, I mean, it looked a little hairy last week when when the long bond sort of blew through 5% and had a couple of wobbly days there, but do you think there's a risk that the administration loses control of the bond market?
Well, so let's take a step back. What has been driving, or one of the big contributors to driving Treasury yields up, there's a couple, but one of them has been the rise in oil prices itself, right? Like if you graph the 10-year note yield and put it next to CL1 or WTI, the front month generic future, you can kind of see just visually that there's been a strong correlation in those moves in the back end. And so this is where I'll call it the verbal intervention, or the open, the open mouth operations.
Jawboning, as it were.
The jawboning kind of comes in on, hey, we've got like a deal where you're going to get to peace and everybody's going to, kiss and love each other in the Strait of Hormuz. It's a concern about the bond market. It's a concern about the repricing there and trying to drive energy prices down. So this, again, kind of circles back to, I'll say risks of what happens if inventories get too low globally. And then at that point, now the other thing, and we haven't talked about other advanced economies, but Japan and the JJB market and the UK gilt market also are under really significant, yields have really moved up there.
Yeah.
And, advanced economy government bond markets, there's a lot of covariance, a lot of correlation in yields. And so, if yields are rising in the UK, maybe asset managers prefer, to go along there. Japan, number one exporter of capital on a global basis as a single country.
Yeah.
Right. If yields are rising there, that may, interest Mrs. Watanabe. I'm kind of referring to the fact that you have some retail investors in Japan who've invested overseas, and they may at that point decide that they want to repatriate those overseas investments and invest domestically at higher interest rates.
Right.
So I think all of those things, and we haven't even talked about the Gulf states. The Gulf states have a lot of work to do to harden their security posture and also to offset the shock and they are big holders of, of treasuries and dollar assets, right? So to the extent that they have to focus more of their dollar holdings on addressing some of the shock from the Strait, they're not going to continue to hold treasuries in the same way, and you've got to find someone else to be the marginal buyer, and so that kind of contributes to yields moving upwards. But I think that they are they've been trying to keep it together, Bruce. They've been trying to keep, but like look at the 10-year forward in the US. We're over 6%.
Yeah.
On the 10-year forward. And, the 10-year term premium, which I like to look at, has also, basically since COVID, is structurally inflected. And I think we're now like, I don't know, call it about 85 basis points on that, which doesn't sound that high. And on a long run basis, it's not. But, we have meaningfully since the COVID years moved up. And I think a lot of this, and just, what is so interesting as well is that we are seeing this pressure in terms of term premia and 10-year forward rates in a context of Treasury doing debt buybacks and Treasury running a short wham. If we weren't doing those things, where would the 10-year forward rate be, and where would term premium be?
Listen, I don't think it's a coincidence that the bond market has a pretty ugly few days last week, and then the next thing you hear is that the U.S. is willing to embrace some agreement that doesn't appear to include some key terms, right? So I think that's like, Scott Bessent must have been in the president's ear, like, listen, you got to do something because, we're getting a look at what could happen if we lose control of the bond market. Right. And I think you saw a taste of that last week. And so that's my theory of why they're potentially settling for something that's not, that doesn't satisfy our stated red lines. But anyway, yeah. So it is a balancing act. I mean, look, the good news is, Bessent knows what he's doing. How long can he hold it together?
Yeah, I mean, I do think that, when you have a principal who, and by that I am referring to President Trump, but when you have a principal who understandably may look at this and say, well, this isn't a great deal, because it isn't, it's not a great deal.
Right.
But, and then markets are sanguine and not understand, I'll call it the kind of reflexivity or the way in which the market's perception that, the market kind of pulling forward that this is going to be resolved.
Right.
And the way in which that's impacting financial conditions now, you can get to some policy error. And I think I've already alluded to several policy errors, one of which was running a short wham into this. Again, we were priced for 2 Fed rate cuts at the beginning of the year.
Yeah.
And now there's been the discussion, which has eased off a little bit around the conversation on the peace talk, but, of everybody looking at a Taylor rule and going, like, where's the Fed? Like, it should be potentially having a discussion about maybe tightening.
Right.
And so, that's policy error number one. But policy error number two was, going into this conflict with Iran, not, having things kind of fully buttoned up and thought through. And, we've kind of stuck our hand in a hornet's nest. And there's not an easy way to pull it out without getting stung here, I guess I would say.
Right. But again, it goes back to these AI stocks just keep going up every single day, and it masks, as Jill's saying, Shanks. I mean, it masks, other messages that should be getting more attention.
Right.
Whether it's Asian currencies or these forward
absolutely
yields.
So sorry, Jill, actually, I also wanted, because you're an expert on so many things, there is one more thing I wanted to touch on, which is banking regulations, right? Like even that, when you're talking about policy errors or the changes in policies, there was a lot of talk about tightening regulations on banks, and then there is loosening.
Mhm.
What are we like really? What should be the case? And do you think loosening is the way out of this, or should there be more tightening of regulations at this point?
I want to see this conversation about what the administration is doing in terms of its deregulatory agenda into
Right.
a broader macro framework. So I'm going to start off by saying, if you're a reader and you've never read Project 2025 that was published before, the election,
Right.
I would encourage you to go read it and to go see what it says about banking and bank deregulation. And what you're going to find, I'll give you the answer, so you don't have to actually go do the homework that Professor Cetina assigned. But the answer is, it says nothing. There was no policy agenda that was
Wow.
meaningful on the part of the administration, at least outlined in that document, before the election. Okay. So what is the crux? What is the driver, if you will, of this banking agenda? I would argue it's twofold. It's to try to address strains in the Treasury market, and it's to try to promote economic growth. And there is this belief that I'm going to, and I'm going to be a little pointed here.
Right.
Somebody who has spent a meaningful share of her career,
Right.
and I still am involved in banking as a professor, but I think that instead of dealing with the fact that we need to address a budget deficit and a debt to GDP situation that is too high, bank deregulation is being viewed as a lever on economic growth that can be pulled to address that situation, because nobody wants to touch the third rail in Washington, D.C. of fiscal consolidation.
Right.
Okay.
You don't get elected doing that.
Right. But you can make yourself infinitely popular hanging out with the crypto bros. You can make yourself perhaps popular doing bank deregulation, right? Though, again, this is where the stablecoin piece is so interesting. Stablecoin is damaging to the funding base of banks. It creates more challenges in terms of smaller banks being able to fund small businesses. Small businesses employ half of US workers. Okay. So this is not trivial. And there was a great report that came out of the UK. And I do think if we go all the way back to the beginning of this podcast, I made the comment that, there's concerns about the future status of the US dollar, right? So, who was the global reserve currency before the US? Was sterling, was the United Kingdom.
Right.
There was a report that just came out this week about the UK banking sector. What was its main focus? The fact that UK banks are not lending to UK small businesses.
Wow.
And so I think people sometimes say, well, this sounds like interesting in theory. No, go off and look at the UK. What is the thing that they are grappling with as the former global reserve currency, former hegemon? It's the fact that their banking sector is now all large banks. They're focused on, more focused on trading assets, less focused on lending to the real economy. And Britain tried to kind of, I'll say, financialize its way out of that transition of being the global reserve currency. And to some degree, this administration, whether they're willing to admit it to themselves or not, they are doing the same thing. And it will be to the detriment of the United States, because if we do not have a banking sector that funds small businesses, we will not have these, the small businesses are the things that become the mid-size and then the large businesses, right? And make your economy dynamic. And so I think a lot of what they're doing, the other thing you were thinking about, perhaps, Shankar, was, did we learn the lessons of 2023?
Right. Yeah.
Right. And there, so just to remind listeners, the spring 2023 banking crisis, which was about liquidity and interest rate risk not being well managed.
Right.
Well, okay, since that happened, what has changed in terms of US bank regulation, nothing.
Yeah, nothing.
Wow.
Right? And, if anything, on liquidity regulation, it is anticipated that we will say, well, as a bank, you don't actually need to have on balance sheet liquidity, Bruce and Shankar. It's enough for you guys to have collateral pledged at the Fed that you could go off and borrow against in the future. And, some people say, well, that sounds really rational. I'm going to tell you 2 reasons why that is upside down and nonsensical. Okay.
Right.
One of the reasons that doesn't make sense, and we saw this in First Republic's failure. First Republic took over 50 billion in liquidity from the Fed and failed anyway. Why? Because we were in an environment of elevated inflation and high interest rates.
Right.
And if you have to borrow liquidity from the central bank when inflation is high and rates are high, it actually erodes your profitability.
Right.
Profitability is your first buffer against loss. And so when creditors and investors in your bank start to see that your profitability is being so eroded, right, they, needless to say, start to pull back. And that was part of First Republic's demise. You cannot borrow your way out of a liquidity problem in an environment of high interest rates, which is where we, at least
Where we are going.
where we are. This is
Right.
where we are, right? So
Right.
this is why this strategy, doesn't work. The other thing is that, President Bush Sr., after the S&L crisis in the 1980s, basically, implemented, when he was elected president, the FDIC Improvement Act, or FDICA, in
Right.
1991. And one of the things that he sought to address was the Federal Reserve had been lending to insolvent institutions. Okay.
Right.
Now, how can I promise Bruce and Shankar that I will, as the Fed, that you can count this contingent liquidity from me in your LCR,
Right.
when if you become, I'll say, a failing institution,
Right.
under the law, I'm not supposed to lend to you? How does that work? I want someone to explain to me the time inconsistency of that, because otherwise you're no longer doing budget, principles. You're doing bailouts, which is part of how we got to elevated government debt to GDP after 2008.
Right. So like even uninsured deposits were getting reimbursed, yeah, during the regional banking crisis.
Yeah, SVBs, uninsured depositors. The other
So we
regional
have the bailout of last resort there from the government, the taxpayer
Right.
money.
Yeah, no, banking crises are super costly. IMF research would put you're well above a 20 percentage point add of to government debt to GDP from a typical banking crisis. So taking guardrails off or not having them, sufficiently in place around liquidity and interest rate risk. We have been 5 years with inflation above target in this country. And yet, what are the guardrails that we've put around liquidity and interest rate risk in the banking sector?
Nothing, yeah.
They're not here.
But Jill, can I ask you, like, your experience as being part of a rating agency, right?
Mm-hmm.
And also the Fed.
Mm-hmm.
And like what you're saying makes sense to us, right? And but there are a lot of smart people like you in these institutions as well. How are they not like? What are they doing? What should they be doing? Or how are they not identifying the pitfalls of this in the long term, you think? Is there a systemic, issue that prevents this, or is it too many things to look at and not enough resources?
Yeah, no, these are great questions, Shankar. I would say from a Fed perspective, a couple of things. I think that number one, the Fed, and this is my view, but convinced itself that its domain was monetary policy, and it was not its job or its place to comment on fiscal policy.
Right.
And that can be accurate, but it doesn't mean that the Fed's actions don't affect fiscal policy. I would argue QE contributed to, the sense in Congress that running ever larger budget deficits was effectively free because the Fed was, anchoring the back end. I think as well, within the Fed, there's a bit of a, I'll say, inherent conflict where, is it challenging as a bank supervisor to take interest rate risk seriously when you're the monetary authority as well and you have a job in terms of the inflation target? And having worked both for two different federal banking regulators, having worked both at the OCC and having worked at the Fed, it is my sincerely held belief that the Fed does have, I'll say, a little bit of a problem in this area in terms of taking interest rate risk and inflation risk, which is inherent. Like if you're going to say interest rate risk, that there's some risks associated with that for banks, then that means that you are taking seriously the risk of a central bank error in terms of monetary policy.
So you think the Fed should be more forceful? I mean, from my point of view, a Fed chairman gets up twice a year at the Humphrey Hawkins testimony and goes, "Hey guys, this debt trajectory is not really sustainable," and the senators or congressmen go, "Oh, gee, it's time for lunch," and that's the end of it. It never, there's nobody's feet are ever held to the fire. It never affects any kind of meaningful policy change, right? And so, it's an unseriousness on Congress's part, obviously, but I think that the Fed could have been more forceful in holding their feet to the fire over the years, regardless of who's in charge of running the place. But
yeah, no, I think if you look back, Bruce, there's been a variety of initiatives where the Fed has articulated or described itself as, trying to promote stability in the Treasury market. And that makes sense to a certain point, right? To the extent that fiscal policy is being run responsibly, that makes sense. But a very famous central banker, Augustin Carstens, once said at a talk that I got to hear him speak at, that the finance ministry is like the person, they're the customer at the bar, okay, and the central banker is the bartender. And depending on where you sit, you either are going to keep asking for drinks,
right,
or if you're the bartender, at some point you have to tell people, no, I'm not doing that. And I think the thing is that, when we got into the business after COVID of, doing Treasury purchases for market function,
right,
in a very undefined way,
right,
then it became evident that, we prioritized kind of dealing with these challenges at the back end more than fiscal policy, encouraging sound fiscal policy.
right.
We've created a codependence, I would say, between monetary and fiscal.
Mm-hmm.
And breaking that is going to be very difficult.
Yeah.
And I do think I completely agree with what you said, which is that, no one is, I'll say, holding Congress's feet to the fire. So it needs to be the bond market that does that.
Right.
And in the absence of the bond market being able to do that, because the Fed is effectively coming in and intervening,
right,
the thing that is reflecting the fact that we are not in a good situation on fiscal policy is the exchange value of the dollar.
Right.
And the exchange value of the dollar versus foreign currencies, and the exchange value of the dollar last year versus precious metals before the Strait of Hormuz shock. That is telling us that, basically, this is the ultimate expression of, debt and money are two sides of the same coin.
Mm-hmm.
And the dollar depreciation is the ultimate expression of Congress's failure and the codependency with the Fed on fiscal.
Because what you're saying is that the bond market has been suppressed. The signals out of the bond market have been suppressed repeatedly.
Yes.
So that Congress just thinks that the bar never closes.
So I think so. One of the questions I wanted to ask you, Jill, is that given you were part of a regulator, rating agency, such a fantastic career, and now you're a professor, right?
Mhm.
And I wish there are more professors like you during my time. So what is your advice for all these kids or all these young graduates who are coming through the ranks? What is your focus on teaching them, and how do they build a career in finance which is fruitful or more effective than just
Yeah.
following the trail of money?
Yeah, no, it's a great question, Shankar. Thank you for that. I think one of the things I try to discuss with students is that some of the trends that we've seen over the last, 40 years, those may or may not endure. And, that we may be at some inflection points, just in terms of, for example, inflation. And I talked about the 10-year yield, kind of inflecting. Inflation, obviously, we've been above target. That's very unusual if you look at, say, the last 20, 30 years. And so it's the need to study history, that history is a great teacher if we're willing to spend the time. And it's not just US history, but also I spoke a little bit about the UK, trying to study the UK experience.
Right.
In the US, we do have a tendency to be, I'll say, a little overly self-referential.
Right.
And not think that we have any thing that we can learn from other countries. There's a lot we can learn from the experience of other countries and past crises. So I think that is very, very important. I think the other thing is foundationally for students, to not, I'll say, get overly involved in, increasing areas of increasing leverage. So, one of the things that concerns me is like, the rise of, betting markets,
Right.
Also betting in terms of sports betting, these kinds of things, and trying to encourage students to think more about how do they bring finance to bear in ways that basically grow goods and services in the US economy that really add value to their lives and the lives of other people in the US and even in the world. And finance is a beautiful thing. It's a powerful thing when it helps companies, achieve those ends. When finance becomes largely self-referential,
Right.
then I do think this is where we get into the question about how much of it is adding value in the world in a way that is meaningful.
That's wonderful, Jill. Thank you very much for this. And I thought this went fantastically. Thank you for all. Thank you, Jill, again, and thank you all for listening to us. Subscribe to Credit Matters on YouTube, Spotify, Apple, or wherever you get your podcasts, and tune in next week where we'll have another wonderful guest and we'll dig into the latest credit events. If you want to receive real-time reports and market data, you can request a free trial of IGM's services. The link is in the show notes. Thank you again, Jill. Thank you.
Thanks, Jill.
And have a nice weekend, guys.
Thank you, Bruce and Shankar. This was so fun. All right. Have a great weekend.
Thank you.